My name is Carl Kriego, and I am the instructor for the CFA Level 1 prep course here at the New York Society of Security Analysts. In this video, we're going to be talking about the course that we offer here for preparation for the CFA Level 1 exam. When you sign up for one of our courses, either lines of videos or live instruction, you'll receive study notes that I've prepared that cover all of the study sessions as well as all of the learning outcome statements. You'll also receive a Q-bank, question bank, divided up by topic areas such as equity, financial analysis, reporting, etc., that has more than 1,200 questions and their answers. And this is the equivalent of the number of questions on 5 CFA 1 exams. So before you even begin taking practice tests, you'll have the equivalent number of questions that would be on 5 CFA exams to review. Plus, regardless if you take the live instruction or video instruction, you will have email access to me, and I will respond to your emails within 24 hours of receiving them. Our offerings are a 17-week class. We have a 13-week class as well. It's on Saturdays. We have a boot camp. It's toward the end of the CFA season, 4 days of intensive review. Well, we also have a problem-solving workshop, which all we're doing all day is simply going over level 1 type questions and getting an understanding of how they ask questions on the exam and how to efficiently and effectively answer them. We also offer specialized instruction as part of this, how to use the HP12C and the TIBA2 Plus calculators. These are the only 2 calculators that are permitted on the CFA examination. And for those of you who need some special help with either quantitative methods or financial accounting, we have a 1-day workshop on basics of quantitative methods and the basics of financial accounting, and these will set the foundation so that you'll be able to transition much easier into the topics covered in the CFA curriculum. Now I would like to show you what our notes look like so that you get a flavor for that. And what I'm going to be doing is doing equity valuation models, dividend discount models. So we see the topic area here, and it's coordinated to the CFA curriculum, and you'll see the pages that this is covered within the required CFA readings. We begin by looking at intrinsic value and market price. You see the 2 definitions here. In the notes, key definitions are in blue. So intrinsic value is a true value. It's based upon quantitative analysis of a security's cash flows. The market price is that the observable price, that what we see in the marketplace. These 2 may not be the same. And it's on this basis then that we'll be looking to whether buy, hold, or sell a particular stock. The key assumption is that the intrinsic value is the true value of the security. The market will wake up someday and say, oh, we're either too high or too low, or we're fairly priced, and the stock will move to its intrinsic value. So if the intrinsic value is greater than the market price will move up to its intrinsic value, and our strategy then would be buy that asset because it's undervalued. If the intrinsic value and the market price are equal to each other, then the asset's fairly priced, we will hold the asset. And if the intrinsic value is less than the market price, then the market price will decline to the intrinsic value. As the price will go down, we would sell the security now or sell it short to make a profit on its expected downward decline. You can see the difference of the different equity valuation models. Each one of these are covered in the curriculum. We have the discounted cash flow model, one we'll be looking at in here. And it goes back to the first one, goes with a point that the value of any asset is equal to the present value of its cash flows. So that's why we see in here that for equity, we have the dividend discount model that determines the intrinsic value. Or for stocks that do not pay dividends, we have key free cash flow models and we'll talk about free cash flow when we get to it in the course itself. We also have second one, market multiplier models, where we're looking at PE multiples, price to sales multiples, price to book. Some of these we'll be calculating as part of the curriculum. Others we'll be looking at them as a means of determining whether a stock is overpriced or underpriced. And of course, asset valuation models. Intrinsic value, we look at the value of the assets, we subtract out the value of the liabilities, and that then gives us the value of the shareholders' equity. And these are now, we have to take them from their book values to their actual values, their market values. And so we talk about the process of doing this. We don't do too much of this at level 1. This is more of a level 2 topic. The first one we're going to get into, the dividend discount models in here. First off, the assumption is, very important in here, a company has unlimited life, it goes on forever. So that dividend stream that we're getting goes out to infinity. And therefore, the value of the asset should be equal to the present value of its cash flows. We see here the basic dividend discount model. Key formulas in the notes are in red. So anytime you see a formula in red in the notes, it means that you should know this particular formula. The basic dividend discount model is just simply taking each dividend out through time and discounting it back to its present value. And we have also, we're discounting it back by the required rate of return. This could be the market's required rate of return and investors' required rate of return. And during the course, we'll be talking about how to calculate these different required rates of return. If there's a 1-year holding period, we're buying the security now, we're going to sell it within 1 year, then our value is the next dividend. Now notice here, an important concept is that it's always D1. It's the next dividend. The current dividend, D sub 0, is already buried within the price of the security. So therefore, the market is always forward-looking, so it's bringing now to bear the future dividends in here. And we have P1's our expected selling price within 1 year. Notice that D1 right here is equal to the current dividend, the last dividend, times 1 plus G, G being the growth rate. We have the growth rate of dividends or the growth rate of the company. The two terms are interchangeable. Now, how do we get the growth rate? Well, we take our return on equity times, we have this little B right here. This is the earnings retention ratio, which is the percentage of earnings that is retained by the firm and not paid out as a dividend. Now, there are different ways of getting P1. It could be given to you on the test. It could be a function of discounting back the next dividend and a price at the end of the next period by 1 period to get to P1. Or we could take the D2 constant growth rate model, we'll talk a little bit more here, times the required rate of return minus the growth rate, and that discounting it back 1 period then gives us then P1 here. So we have these different ways of getting to it, and then of course we'll be looking at these in greater detail when we look at some problems. And we have one coming up right here. Problems are in green, and they're exercises based upon the past concepts. So we have last year a stock paid a dividend of $2. Dividends are expected to grow at an annual rate of 10% per year indefinitely. So they'll keep going out to infinity with that 10% per year. The intrinsic value of the stock, you have an investor has a required rate of return of 15%. You'll notice in here too, I've circled the key elements. And in your test booklet, I recommend that you do the same thing, because when you go back to check your work, you don't have to read the whole thing. You can pick up the numbers that you need right there by circling. So we can calculate out some things here. We can do the D1, take the current dividend times 1 plus the growth rate. So we have $2.20 as our D1. We can take that then and multiply it again times 1.1. This will give us D2. We could take then the D2 here and put it over R minus G, and that would give us then a price at the end of 1 year of $48.40. Or we could take D2 down here and then multiply it again times 1.1. That would give us the dividend for the 3rd year. Again, R minus G. And this would give us P2 here, 2nd year. All right? So now what we can do, and if you look here, we can then take the dividend for year number 2 and the price for year number 2, discount that back by 1 period, and we get $48.40, which is exactly the same as we got by calculating P1 only. We put it within our model. So here's D1. Here is P1. We discount that back to time 0 here, and the intrinsic value is $44. And we would compare this then to the actual market price. Now, what we're actually playing with in here, and we haven't gotten to it yet, but we're actually using what we call the Gordon model, or the constant growth rate dividend discount model. Now, at this point, we would stop the lecture, and I would put up on the screen a problem similar to this one, and have you work it in class, and then we would go over it together to make sure that you understand the concept and the different interrelationships that are there. And then we would move on from that to multiple year investment horizons, where we have the dividends are given to us. It's not a constant growth rate in here. We have the future price is given to us in here. And you'll notice what we're doing in here now is discounting all of this back to its present value. In this type of problem, we're not going to do it here in this little video, but what we'll be using here is the cash flow registers in our calculators. And when we have all this information, by using the cash flow registers and solving for NPV, we can get this value right here very quickly. So our course here at NYSSA is based upon going over the material and then review in class, and then you have the practice problems that we would supply to you to work as homework over the week. We come back in the next week, and the first thing I'll do in class is ask if any questions over any of the problems I have assigned out of the practice problems, out of our Q bank. And I may go over a few of those that I believe are very important to make sure that we have a thorough understanding of them to get you prepared for the CFA exam. I wish you the very best of luck with your preparation for the Level 1 exam, and thank you very much.